Hey, let's get ready for your real estate exam by practicing national and state questions, Texas state questions. Okay, I am in Texas. And of course, studying your vocabulary, memorizing it, learning it, whichever way works on other videos that I have. So practice, 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 lots of questions and get your mindset in the right way, okay? Positive thinking and affirming, I passed, I passed, I passed. So let's go on with those national questions. I explain them extra than just reading them and also point out keywords in the questions and the answers. So this is the book that we're using by the Metling family. It's a father and son publishers. Okay, and of course, several other publishers too. So I don't want to leave them out. So anybody watching the replay, this class is live and designed to have students participate during the live, and I help them out if for some reason they answer it wrong. So you may fast forward and get to the answer after the question. Again, national questions that apply to all 50 states. And happy October 1st. All right, number 36. Which of the following statements properly describes how to apply the income capitalization approach to appraisals? So this test is dealing with appraisals and economy or economics. So A, apply a rate of return to the price paid for an income property. B, divide the income a property generates by a rate of return, which is usually a percentage, a number. C, estimate the amount of income a property must generate to return the capital amount invested in it. Or D, estimate the rate of return a property owner receives from income generated by the property. So, which of the following statements properly describes how to apply the income capitalization approach to appraisals? So there's an income capitalization rate formula, right, that you can use. All right, so the answer here is 636B. You divide the income a property generates by the rate of return. So the income capitalization approach to an appraisal is dividing the income a property generates, rental income, multiplex, residential, single family, by a rate of return, which could be, 5, 6, 7, 8. It's usually 10 or below. And that's what investors use to determine whether it's a good property to purchase or not by the capitalization rate. So 636B. So we'll move on to the next one. I'm working on getting my Facebook going here in the YouTube so that I don't miss. Good morning, Cindy. We just answered one question, 636, and the answer is B. Which of the following statements properly describes how to apply the income capitalization approach to the appraisal? And the answer is B, divide the income a property generates, by a rate of return. Oh, that didn't work, did it? Dang, just one little space more. Okay, number 37. A strength of the income capitalization approach is that what? What is the strength of the income capitalization approach? If you're not familiar with that, go back and look that in your review book, in your prep book, and the formulas. So income capitalization approach is uses a rate of return that is required for all potential purchasers in a market. B, yields an accurate projection of investment income. C, uses a method that is also used by investors to determine how much they should pay for an investment property. Or D, can be used with any type of property in any market. Type your answer in the chat. So the answer that's coming up right now is for 36, not for 37. All right. Yes, the answer is C. Uses a method that is also used by investors to determine how much they should pay for an investment property. So when investors are looking at multiplex units, apartment complexes, other commercial properties, they'll look at the capitalization rate. So that was 37. Let me show answer 36 for those watching the replay. All right, number 38, a math problem. Okay, here we go. A property is being appraised using the income capitalization approach. Annually, it has estimated gross income of $60,000, vacancy and credit losses of $3,000, and operating expenses of $20,000. Using a capitalization rate of 10%, what is the indicated value? Then round it off to the nearest thousand. So you have a gross income of $60,000 annually. Okay, estimated gross income, $60,000. Vacancy and credit losses of $3,000, and operating expenses of $20,000. So how will you calculate this? So you take your income, right? Minus your expenses, minus the losses. Okay, so 60 minus 20 gives us 40, minus 3 gives us 37,000. And it says we have a capitalization rate of 10%. So we divide 37,000 by 10%, which will be rounded off to, not rounded off, to a decimal 0.10, and rounded off to the nearest thousand. Yes, the answer is 37.8. It is 370,000. Very good, Cindy. Oh, I forgot to write 638. Okay. All right. So number 39. An apartment building that sold for $450,000 had monthly gross rent receipts of $3,000. Okay, had monthly gross rent receipts of $3,000. So always pay attention to monthly, yearly, quarterly, all that. It's a key point. So it sold for $450,000. What is its monthly gross rent multiplier? A, 12.5, B, 0.01, C, 0.08, or D, 150. So gross monthly gross rent multiplier. And it has a gross rent receipts of 3,000, right? So on here, the monthly gross rent multiplier, to find that out, it's 450,000 divided by the monthly gross rent. Okay, will give us a rent multiplier of 150. So the answer is D. Very good, Cindy. All right, number 40. A rental house has monthly income of $1,200, monthly gross income. Okay, what do we know about gross? Gross is before expenses, right? A suitable gross income multiplier derived from market data is 14.1. What estimated sales price to the nearest thousand is indicated? So 1,200 is the monthly gross income and a gross multiplier of 14.1, a gross income multiplier. So type your answer in the chat. Oh, 169, B, 102, C, 203, or D, 173. So on this one, we'll multiply the monthly gross income, okay, by 12. So we've got 1,200, right, by 12. So that'll equal 14,400. So this times 14.1, because in the other problem, we had the purchase price, right, divided by the cap rate. So here we multiply the cap rate, okay, by the total. So 14.1 times 14,400, that's 1,200 times 12, will give us, rounded off to 203,000, C. Good job. Look at Cindy go this morning. She's on a roll. No, that's not going to work. It's having challenges here. Okay, I'll have to go smaller. All right, number 41. A certified appraiser is one who received certification by whom? Certified appraiser received certification by A licensed real estate school, B, the Appraisal Institute, C, the state in which the appraiser operates, or D, the Appraisal Review Board. Yeah, well, you're not trying, you're doing it, Cindy. See, Cindy says, trying to make sure I pass the exam. Yes, well, you're doing really good. So certified appraiser is one who has received certification by whom? No, it's by the state in which the appraiser operates, not by the review board. Oops. They receive the certification by the state in which the appraiser operates. As we get, good morning, David. We get our license, right, from the state, okay, from the state Texas Real Estate Commission. So it is by the state in which the appraiser operates. Number 42. Okay, let's make that bigger. I spoke with the author, or I emailed. He couldn't talk because of the publisher of this book is located in Florida, and Florida is having major floods, right, with the hurricane. So telephones weren't working. However, email and internet were. So we were able to communicate via email. All right. So the act that required federally related appraisals to be conducted by a certified appraiser is known as, so the act that required federally related appraisals, okay, certified by certified appraisers. So A, the Financial Institutions Reform, Recovery, and Enforcement Act, known as FIRREA. B, the Uniform Standards of Professional Appraisers Act, known as USPAPA, something like that. C, the Appraiser Foundation Authorization and Reform Act, AFAR. Or D, the Federal Institution for Regulation and Enforcement of Appraisal Act, FIRREA. Almost like A. So the act that federally related appraisers to be conducted by a certified appraiser. This one might be, so the keyword act is not a keyword, right? They all have act in it. And then we have federally related, but you got to be careful about that. So federally related appraisers, the act that certifies appraisers have to follow. Yes, the answer is A, the Financial Institutions Reform, Recovery, and Enforcement Act. Because what? The appraisers are used to determine what? A value of a property when someone is purchasing it or refinancing. So it's by financial institutions, right? Yes, it's federally, but it's not a federal institution of regulation. It's for the Financial Institutions Reform, Recovery, and Enforcement Act. Know the acronym, FIRREA, in case you ever get the acronym versus the description. So it makes sense, right? Because appraisers are required by lenders, but sometimes by owners when they want to know what the value of their property is per the appraisal before they put it on the market for sale. However, that doesn't mean that that's what it's going to sell for, because the final purchase price is determined between, the agreement of the seller and the buyer. That's what determines the purchase price for today. It's not the purchase price for today, okay, or the value for today is not what's listed at the county records or the appraisal, but the appraisal is a basis to help people determine whether, they should pay that price or not, right? Because the lender is not going to pay more than what it appraised, or they're not going to loan more a percentage of the appraisal value. That's what they're going to loan on. However, the buyer could still end up buying it if it appraises for less, if they really want it. Because, real estate is an emotional purchase for some. For investors, it's basically a numbers purchase for, serious investors that know the investing. Right? So it's not an emotional, it's preferred not to be an emotional purchase or sale when it's an investment property. We don't get attached to them. And I say we because I have invested in quite a few properties in Oregon and in Texas. All right, number 43. As a component of real estate value, the principle of substitution states that A, if two similar properties are for sale, a buyer will purchase the cheaper of the two. B, if one of two adjacent homes is more valuable, the price of the other home will tend to rise. C, if too many properties are built in a market, the price will tend to go down. D, people will readily move to another home if it is of equal value. So the component of real estate value, the principle of substitution, okay, states that, which is it, A, B, C, or D? All right, I've got David already saying he believes that it's A. Anybody else? And yes, the answer is A. If two similar properties are for sale, a buyer will purchase the cheaper of the two. So that's why we do a competitive market analysis to share with the seller when we're going to a listing appointment, hoping to get that listing, right? Is we compare with competitive properties that are next to it or in the neighborhood or within half a mile, sometimes even more if there are not that many homes around. So we want to make sure our seller has the best price available. And sometimes when we price them a little bit lower, they might get a higher offer in a seller's market like we just had. For almost 1 or 2 years, we had a major seller's market with multiple offers. Then the strategy sometimes is price it lower and create some frenzy, therefore getting multiple offers, bringing about a higher offer. Because our job as a listing realtor is to procure a ready, willing, and able buyer at the best price for the seller. Make the best money for the seller. Way to go, Cindy. All right, number 44. Highest and best use property is that use which A, physically and financially feasible, legal, and the most productive. B, is legal, feasible, and deemed the most appropriate by zoning authorities. C, entails the largest building that zoning ordinances will allow developers to erect. Or D, conforms to other properties in the area. So the highest and best use of property. Okay, so far we've got an A and another A. Yes, the answer is A. So the highest and best use of a property, it is physically and financially feasible, legal, and the most productive, right? Legal because it's got to follow the local zoning authorities or ordinances. It's not that it's the largest or conforms to other properties in the area and deemed most appropriate by zoning. No. Very good. I'm probably going to have to make it. Ooh, yeah, that's a long one. All right, number 45. Here comes a math problem. Lynn just bought a house. She paid $187,500 for it, even though it had been listed at $195,000. An adjoining property owner, Ken, had tried to buy the property for $185,000, but had been refused. He now offers Lynn $190,000 for the house. Lynn is interested, so she hires an appraiser. The appraiser returns an estimate of value of $200,000. Which of these numbers can be called the market value? A, 187.5, B, 190, C, 195, or D, 200 thousands, okay? So Lynn paid 187.5, and it had been listed for 195. An adjoining property owner tried to buy it for 185, okay? So paid 187, listed for 195. Ken offered 185 and was refused. Now he goes back and offers 190 for the house because it was listed at 195. So he lowballed it, right? But 185 is lower than what Lynn paid for it. So Lynn is interested. So she hires an appraiser, and the appraiser says, well, the value is 200,000. So which of these numbers can be called the market value? No, David, it's not A, because that's what she paid for it. That's not the market value. So there's two ways to determine the market value, right? When a buyer and a seller come to an agreement. Well, they don't have an agreement yet. So what's the next thing? The appraisal, right? The appraisal comes in at 200,000. So based on the appraisal, that's the current market value. Now, should the seller and the buyer decide on 195, okay, as the list price, or they decide at 190 and it closes for that price, that becomes the market value. But right now, there isn't a decision between the buyer and the seller. The seller is hired an appraiser to make a decision on whether to accept 190 or to ask for more because she's got it listed at 195. So good job, Cindy. Okay, number 46. Any questions? Let me look on YouTube and Facebook. Nope. All right. Yeah, there's some internet issues. I got the wheel of death, which is called in an Apple computer when it's going round and round and round and round. It used to be a colorful apple in the Apple computers. All right, number 46. A notable weakness of the sales comparison approach to value is that A. So notable weakness to sales comparison approach to value is that A, there may be no recent sale price data in the market. B, the approach is not based on the principle of substitution. C, the approach is only accurate with unique special purpose properties. Or D, sales price cannot be compared since all real estate is different. So the notable weakness of the sales comparison approach. That's when we're looking, a CMA, right? Comparison market analysis, when we're looking for sold properties within the area that are similar to the subject property. So, look at the answers. The first one says there may be no recent sale price. B, the approach is not based on principle of substitution. C, the approach is only, so, careful with when they use little words only or not or never or always. D, sales price cannot be compared. The answer is, let's see, have both answered? Yeah, the answer is A. There may be no recent sales price data in the market. So depending on what the market is like, and if there aren't that many properties that have recently sold within the last, 6 months, if it's a fast market, 3 months, 1 month, then that is a weakness because we can't find any recent sold properties, right? And it says there may be no recent sale price data. So sale properties that have sold, because that's what we compare for buyers, what type of price to offer, give them a range, is properties that have sold within the area. And sometimes, we can't find any. So then we may have to go to the cost approach, which is a little tougher because you have to then research what's the cost of materials to build the similar property. Number 47. So did you get that, David? Because you answered the approach is only accurate with unique special purpose properties. No. Okay. Remember I pointed out only. Okay. That is most of the time a bad keyword. Only in certain things like laws, okay, that it says must be or is only, then yes. But in this type of situation, those are little keywords to notice when you're looking for answers. So it's not only unique or special purpose properties, right? Because not all are special purpose properties, right? They're residential, they're commercial, they're industrial, they're agriculture, right? Multifamily, all right, which is considered commercial. All right, got it. Number 47. In the market data approach, an appraiser, market data approach, so comparables, A, chooses nearby comparables, adjusts the subject for differences, and estimates the value. B, gathers relevant price data, applies the data to the subject, and estimates the value. C, selects comparable properties, adjusts the comparables, and estimates the value. Or D, identifies the price previously paid, applies an appreciation rate, and estimates the value. So last week we talked about comparables, and there was a key point to pay attention to. Do we adjust the subject property price or adjust the comparable price? Okay, answers. Okay, let's see. Cindy says C. C, wee. I always think of Tyler Perry with Medea, one of my favorite actors, Tyler Perry. All right. Yes, the answer is C. Selects comparable properties, adjusts the comparables, right? Not the subject property, and estimates the value. So we had a question last session. I think that it was, do you decrease or increase the price of the comparable to come up with something that agrees with the subject property as to what the real market value is? So we leave the subject property alone and we adjust, like let's say you add a bathroom or you add a pool or you deduct the pool or, deduct a bathroom depending on what the subject property has. So the adjustments are made to the comparable. So very good. It says, yeah, me too. Those movies are so funny. Yeah, they are. Love Tyler Perry. But I heard he wasn't going to be making any more of those types of movies. But he's hilarious. All right. 647C. Guy, we have something in common. We like to laugh at Tyler Perry movies. All right, number 40. What were we on? 47. Okay, I can make this larger. Ooh, that didn't work. No, that's not going to work. All right, number 48. In the sales comparison approach, an adjustment is warranted if, the appraiser is making the adjustment, right? Or we as realtors, but we're talking about appraisers. So A, the buyer obtains conventional financing for the property. B, the seller offers below market seller financing. C, a comparable is located in another, albeit similar neighborhood. Or D, one property has a hip hop. Oh my goodness, not hip hop, a hip roof, and the other has a gabled roof. Oh my gosh. Sorry about that. So, sales comparison approach, an adjustment is warranted if the buyer contains conventional financing, the seller offers below market seller financing, a comparable is located in another, albeit similar neighborhood, or one property has a hip roof and the other has a gabled roof. Yeah, that's a hip hop, right? All right, so what's the answer here? The answer is actually B. And I'll see what the answer says. So the answer says the seller offers below market seller financing. So the principal factors for comparison and adjustments are time of sale, location, physical characteristics, and transaction characteristics. So transaction characteristics is it a cash sale, a cash purchase, financing, seller financing? What the appraiser is going to look at that when determining the appraisal, right? Because if it's a cash offer, sometimes the seller may accept less. If it's a VA or FHA financing or conventional, there could be differences, right? There also may be buyer closing costs, that a seller will contribute. So that's why they're saying an adjustment is warranted when the seller offers below market seller financing. So an appraiser will look, you would think, why are they looking at how it was purchased? Well, that's an important factor, because that'll determine on a price that a seller accepts, or if they contribute to closing costs. All right, 648B, the seller offers below market seller financing. That warrants a sales comparison approach adjustment. All right, number 49. To complete the sales comparison approach, the appraiser does what? A, average the comparable values. B, weights the comparables. C, identifies the subject's value as that of the middle value of the comparables. Or D, identifies the subject's value as that of the nearest comparable. So to complete the sales comparison approach, the appraiser does what? Does the average, weights, identifies subject value as the middle of comparables, or identifies subject value as the nearest comparable. So remember, comparable, we're going to have several comparable properties, right? And the appraiser is going to get that. And then we already know that the appraiser is going to make adjustments, right, according to, differences in the properties. Hi, let's see, Joya. Yeah, Joya, Joya. I think I'm pronouncing it right. Oh, we're on number 49. So let's see. So far, I've got A. Ooh, no, it's not an average. Okay, because remember, so to complete the sales comparison approach, the appraiser is going to adjust values of the comparables. So if the subject property has an extra bathroom and the comparables does not, then he's going to have to add, a bathroom to the comparable to come up to see if it comes up to the value of the subject property. Okay. If the subject property has 2 bathrooms and the comparable has 3, then he's going to subtract 1 bathroom and see if it comes close to the subject property, not taking all 3 or 4 or 5 comparables and just averaging. Okay, they don't just take an average. So they've got to add or subtract. They're adjusting each comparable property based on the amenities or the characteristics of the subject property. Oh gosh, what did I do? Disregard that. Okay, I typed the wrong answer. So the answer here is B, weights the comparables. Okay, he weighs the comparables, right? Up or down, adjusting the price up or down. So anybody watching the replay, it is B, not A. So that was an error, a typo error. I was looking at David, Joy, everybody's answer, and I typed A. I should be typing 39. So do y'all get that? That he weighs the comparables. B. Yes, B. Get ingrained in your head, comparables is not an average. Now, when we do comparables ourselves as realtors, and we don't go into detail like an appraiser does, adjusting each property because the software may not easily allow that, then you might say, okay, let's take an average. That is not the best approach to coming to a comparable purchase price, okay, for the subject property. It is adding and subtracting to the comparables. We leave the subject property alone, okay, and we adjust the comparables. That's what appraiser does. And that's what we as realtors, okay, some softwares will allow us to do that we use for running comparables. The MLS, RPR, which you're going to learn is Realtor Property Resources. It's a national software, RPR, and we can research any property in the U.S. Oh, gosh. Okay, y'all got that, right? Yes, you got that. All right, number 50. One weakness of the cost approach, okay, cost approach now, okay, not comparable approach, cost approach. One weakness of the cost approach for appraising market value is that A, builders may not pay market value for materials or labor. B, market value is not always the same as what the property costs. C, comparables used may not have similar quality of construction. Or D, new properties have inestimable costs and rates of depreciation. So what could be a weakness of the cost approach? Because when you're dealing with cost, you're dealing of cost of what current supply prices, right? And yes, the answer is B. Okay. Market value is not always as what the property costs. Okay. The property could, the property material cost, the cost of of that particular property's material could be less than what the actual market value is. And depending on the quality of it, right, and the construction, it could be more than what the market value is. If an individual, the owner wants everything, high quality. For the most part, individuals like to build homes because it'll be less expensive than buying an already built home. And of course, they like something new. So all of you did awesome. Very good. Okay, any questions on national? We're going to move on to state questions. So I'm going to shift. I got my board. I wrote some of my goals a couple days ago, right? Of things, my priorities. All right, let's go to state. So any questions? Any questions? Going once, going twice. We're starting with special topic 6.6. So anybody watching the replay, we are going into Texas state questions. And we are starting with number 16.6. And this topic here has to do with special topics. Okay, in your preparation for your exam or taking your courses, right, there's a special topic section. All right, change your thinking cap from national to state. Okay, let me type it here. Texas state questions. So October 1st, we're going into the Halloween month, the autumn month. Colors start changing. Weather starts changing a little bit more or quicker. All right, number 6, Texas state questions. Following the tax sale, in a foreclosure proceeding, a homeowner can regain full ownership by paying all amounts owed plus fees and charges. In this scenario, which of the following is true? Okay, so a tax sale in a foreclosure proceeding, right? And that usually happens at the courthouse steps or at the courthouse right outside the entrance. A, the homeowner may do this since he or she is exercising their equitable right of redemption. B, the homeowner may only exercise a statutory right of redemption prior to the tax sale. C, the homeowner may in fact exercise this statutory right of redemption provided the property is the principal residence. Or D, the homeowner may exercise the statutory right of redemption provided it is done within 3 years of the tax sale. So type your answer in the chat. And I will be right back. I love my morning coffee. Okay, so I've got 6B, 6A. Anybody else? The answer here is not A, not B, but C. So C says, so in a tax sale, okay, there is a right of redemption, okay, in Texas. And it is C. The homeowner may, in fact, exercise the statutory right of redemption, provided the property is the principal residence. Okay, so I would have said, hey, pay attention to may. Well, they all have the word may in it, so that's not a key word. So it is not, so let me type the answer on here. So 16.6C, and I'll explain why. So in the, let's see, some of you answered, well, most of you answered AAA. The homeowner may do this since he is exercising his equitable right of redemption. No, so it has to be their principal residence, okay? And it cannot be B because it is not the redemption is not prior to the tax sale. Okay, Cindy, the redemption happens after a tax sale. In the state of Texas, they're allowed 2 years. We're allowed 2 years tax of redemption. And then, of course, we have to pay fees and charges. And typically it's 25% interest the first year for the amount that was paid by the whatever taxes were due, plus charges. And the second year, it's 50% on the balance that was due, plus charges, plus other charges. Okay, so that's why investors like to buy tax sales, because they're going to make 25% or 50% if that owner, principal residence owner, ends up buying it back. And during those 2 years, the investor can't sell it. However, they can rent it, right? And make money off of it. So if they owe, if the owner owes, $5,000 in taxes, $10,000 in taxes, and the property is worth $100,000, $200,000, investors like to go and buy those, because if the house is rentable, in addition to buying it, end up owning a property for $10,000 versus $100,000 or $200,000, and then making rental income during those 2 years, they're like, wow, great. If the owner does not exercise that redemption, okay, provided it's their primary residence, their principal residence, then that investor ended up getting a $200,000 home, or 100 for 10,000. Okay, so the answer is C. Most of you answered A. The homeowner may do this since they are exercising their equitable right of redemption. No. It's a state law that allows them to redeem the property when it is their primary residence. Every state has a different probably exemption or redemption statute. The last one, of course, wouldn't be right because it says 3 years. And you may not have known that. So equity right of redemption is also termed right of redemption or equitable right of redemption, is a defaulting mortgagor's right to prevent foreclosure proceedings on the property and redeem the mortgage property by discharging the debt secured by the mortgage. So that's why it's not A, because the equitable right of mortgage has to do with, equitable right of redemption has to do with their mortgage, not property taxes. Okay, so go back and review what equitable right of redemption is. And so I just Googled it so I could read it to you. And so that is a defaulting mortgagor's, right, is the owner, right to prevent foreclosure proceedings on the property and redeem the mortgage property by discharging the debt secured by that mortgage within a reasonable amount of time, thereby curing the default. So they're in default by not making their mortgage payments, right? And they have the right to redeem that property by paying whatever is owed on it and prevent a foreclosure proceeding. They might be in pre-foreclosure because they're in default. So the equitable right of redemption has to do with the mortgage. Here we're dealing with a tax sale, property taxes that are due every year on that property. Okay. So that's the difference. Equitable right of redemption has to do with the mortgage. Tax sale has to do with what? Property taxes. So Google it real quick and you'll understand it instead of searching through books. I love to Google things. How do they say it in Spanish? Googlealo. That's what my brothers, we joke around. Okay, number 16.7. Which of the following agreements are enforceable? So remember, these are special topics. A verbal 30-day month-to-month lease. B, an oral agreement to buy an oil interest in a property. C, a written lease signed by the landlord's son and unauthorized representative. Or D, an oral property conveyance between a judge and a juror. So which one of the following are enforceable? Yeah, googlealo, man. So remember, what type of property, what can be enforceable? Even though, even though it's oral or verbal. So 3 of them have to do with oral, right? So A, a verbal 30-day month-to-month lease. B, an oral agreement to buy an oil interest in a property. C, a written lease signed by the landlord's son and unauthorized representative. Or D, an oral property conveyance between a judge. So it says, which one are enforceable? Okay, a written lease signed by the landlord's son an unauthorized party would not be enforceable, right? It would like, okay, throw it out, not valid. So the answer is a verbal 30-day month-to-month lease, A. Because remember, a lease less than a year can be verbal. Yeah, it's best to have it in writing to be enforceable. However, leases less than a year are not required to be in writing. Let's see, what did you say, David? Oh my God, I thought it said authorized. Oh, wow. It says unauthorized. Yes, I've made that kind of mistakes too. Don't be sad. He meant said. So it is a verbal 30-day month-to-month lease, right? Oral agreements on oil interest and property, no. Oral property conveyance of a judge, no. Those things have to be in writing. And a unauthorized representative to sign an agreement, no, that's not valid. Okay. 16.7a, already did it. All right, number 8. So glad you caught that. Which of the following is a legitimate power granted to a landlord or a tenant? Landlord-tenant laws, every state has them. A tenant's right to vacate a week-to-week rental with at least 1 day's notice. Okay, so legitimate power granted. Okay, so which one is true? To a landlord or a tenant? B, a tenant's right to apply the security deposit to the last month's lease in the absence of damage. C, landlord's right to evict a month-to-month lease tenant with 30 days advance notice. Or D, a landlord's right to waive liability for not maintaining habitability of the premises. So which one is a legitimate, a can-do, legal? Type your answer in the chat. All right, so far we have CC. And yes, the answer is C. Landlord's right to evict a month-to-month lease tenant with 30 days advance notice. So even if it's month-to-month, okay, it's a 30 days notice is required. Or it's best, okay, nobody ends up creating any issues, that gives the person time to find something else or gives the landlord time to find something else. Okay, so number 9. Which of the following is true regarding subletting a rental property? So true, a true statement. Which one of the following is true regarding subletting a rental property? So what is subletting? So A, tenant may freely assign unit if lease is for more than 5 years. B, tenant may assign or sublet, but must return property to original condition prior to the subtenant's occupancy. C, tenants are free to assign their lease obligations, but may not sublet without the landlord's permission. D, tenant must obtain landlord's prior consent to sublet the apartment. So think about it. If it's in writing or if it's oral, what is required? Let's see. Okay, so far I have D. Gee, I was typing the wrong answer. And yes, the answer is D. Tenant must obtain landlord's prior consent to sublet the apartment or sublet the property. Very good, David. Number 10. Okay, Cindy got it too. Which of the following is not a landlord justification for keeping a tenant security deposit? So what are security deposits used for? Okay. A, to eliminate normal wear and tear to the apartment, including painting and carpet cleaning. B, to offset rent owed by a vacating tenant. C, to repair damage of the plumbing system. Or D, to cover excessive damage caused by a dog, even though dogs are permitted. So when individuals own investment properties, they do it to have passive income, right? But along with owning investment properties, there are things that we must do and have money on the side in case we have to do any repairs and other things, right? So which one is not a landlord justification? It is not B. Take another attempt at it. No. And it is not C. You can use the security deposit for those things. Okay. So which one is not? Normal wear and tear to the apartment, including painting and carpet cleaning. Okay. Those are normal expenses that a landlord is going to have when you have an investment property. And some landlords will request a cleaning deposit. Okay, but that's separate from the security deposit. Okay, like you have your first month and last month's rent and then security deposit for damages. So offsetting the vacating tenant for not paying rent, yes, they can use it for that, right? Because we're given 30 days before we return any security deposit. So we have up to 30 days to determine how much of that security deposit we can return. It can be used for offsetting rent that's owed, to repair damage to plumbing, or cover excessive damage caused by a dog, even though dogs are permitted, right? There will also be probably a pet deposit. But normal wear and tear, that's like us owning a home. You know, that's our responsibility. And also a landlord's. Painting and carpet cleaning helps them get better rent. So that's why they're renting, because the property will depreciate every year. So they get a tax write-off of depreciation. They're getting money on it. We get to write off the property taxes, not the loan. Okay. So there are many pluses to owning investment properties that are rentals. There's a lot of negatives too. So most of you answered C, D. Yeah, no. C, of course, you can keep the security deposit for plumbing damage and for vacating. So for offsetting rent, because these are caused by the tenant. These are things caused by the tenant, but not normal wear and tear. That's the responsibility of the landlord. All right, now, someone that could be labeled as a slumlord, you know, they intimidate tenants and stuff. They want to charge for everything. Well, that's not the right. If the tenant takes them to court, according to the landlord-tenant rights or tenant-landlord rights laws, you know, that tenant could win if they did everything according to the landlord-tenant laws. All right, number 11. Yes, got it, Cindy. All right. So number 11, In maintaining proper relations with tenants, landlords and tenants are obligated to meet certain apartment security standards. Which of the following accurately identifies one such standard? Okay. They obligated, okay, meet certain apartment security standards. A, tenants may alter security devices, but at their own expense. B, landlords must install window locks in occupied buildings. Tenants must install security bars for glass doors. C, all security devices must be repaired within a 30-day time frame following tenants' written notice of the despair. Or D, the landlord must rekey the locks within 7 days following a tenant's vacating. So which one are landlords and tenants obligated to meet certain apartment security ones? So which one accurately identifies one such standard? Okay, so far we've got D. And yes, the answer is D. The landlord must rekey locks within 7 days following a tenant's vacating. Okay, so that's one of the standards it says. Now, do landlords actually do that? I mean, who's watching, who's monitoring? The owner owns the property. Now, if it is in a property managed unit, okay, apartment complex, yes, there's going to be somebody watching and making sure that that gets done, right? So that any tenants that left and had a key can't come back and go into the apartment and decide they're going to be angry and start, destroying the apartment or start taking appliances or such. So that is a must, okay? Rekey the locks, okay, within 7 days following a tenant's vacating, and sometimes even sooner, especially if there's some adverse reaction, okay? Or if there's a upsetting, right, because of how I was a landlord, okay? And I'll tell you what, some of the damages that tenants can create because not taking responsibility for their actions or being late or not being able to pay, they'll take it out on the apartment. Okay, an example here. I had an 8-plex in Oregon, apartment building, an old apartment building. Used to be a hotel that had 8 apartments in it. Well, after we remodeled it. And in the old days, some of these apartments, because it was built like in 1905 or something like that, there was a sewerage connection inside some of these buildings, okay? And one of my units had a sewerage outlet, okay, inside the unit. And never thought of eliminating that, okay, because it now had public sewer. Well, one of the tenants that I had to evict or left, they unplugged that, okay, outlet. And I was out of town, out of state, and the tenants called me complaining that there was an ugly smell. That cost thousands of dollars to get cleaned because it had to be a hazardous material being removed. So it has to be a special company to remove that. Of course, the insurance covered it, and I covered the what do you call it? The deposit, right? Or the, gosh, I can't think of the word. So anyway, those types of things happen. They'll take it out on the landlord or the landlady or the building. Okay, so the answer is D. So anyway, I had that building for 10 years. It was kind of like a cash cow, but I invested a lot of money into it. But it was a heck of an experience. I bought that building. Just a quick little story. I bought that building. I had been meditating and affirming, I own a multiplex unit. I own a multiplex unit, right? And all of a sudden I saw one in the newspaper and wow, okay, went and bought it with a business partner. And he was a contractor and he could do all the remodeling and repairs. I knew nothing about buying commercial property. And I put 10,000 down, okay, non-refundable, earnest money. And then I'm like, okay, how are we going to pay for it? and with business loans, right, it can take up to 2 months. So anyway, we ended up having to get equity loans from residences that we had in order to purchase that property. Very interesting, but we got it done. Okay, so David says, can you sue them? Yes. Okay. However, whether you win, even if you win, how are we going to collect if they don't have any money? Okay. It was an area of low value or low income. And I found out after I bought the building that it used to be called a crack house. Well, I lived 30 miles away and I didn't know. And the landlord had it all occupied, but he had it all occupied by a lot of individuals that were into drugs. So it took me years to clean it up, right? By the people and the mess in there and remodeling them. Okay, this was a hotel, so it had the bathrooms in the hallway. Showers were in the hallway. So it was a very interesting investment, to say the least. Okay, but yes, you can sue them and you could win, but then it's our job to go collect the money. Okay, and if they don't own anything, what are you going to put a lien on? If they don't own a car, they don't own anything. Low income is situation. Sometimes, most of the time, they don't own anything. You can ruin their credit. Okay. So anyway, David said, can you sue them? Yes, you can, but it's going to end up costing you sometimes more. And as an individual investor, it's not the same as being a property management company where they have certain rights to ruin your credit and other reporting. It's totally different. So make sure you understand a lot of those things before you go into investing, especially in multi-unit properties. Okay, we're on number, oh, wait a minute. Are we on 12 or D? Oh, sorry, we're on number 12. Okay, Texas Property Code. I got carried away with my story here. Texas Property Code, Chapter 92, is very specific about fire safety regulations. According to code, A, there must be a smoke alarm on at least the ground level of a 2-story duplex. B, fire alarms must be inspected annually by the landlord. C, tenants are responsible for inspecting and repairing fire extinguishers. Or D, there must be a smoke alarm in every bedroom of a dwelling unit. So Property Code 92, very specific about fire safety regulations. So type your answer. Sorry, I got this straight. So anybody watching the replay, you can just fast forward and it's already too late. But that's the thing about this. I can share with you some of my investing experience, real estate realtor experience with buyers and sellers as to what you're going to deal with in the real life. And sometimes it helps you answer some of the questions and understand them. Come on, type your answer in the chatty chat. Going once, going twice. Okay, David said 12D, and that is correct, 12D. There must be a smoke alarm in every bedroom of a dwelling unit. Sometimes they would say, on the hallway, but now we put them inside a bedroom, okay? So that every person sleeping in that bedroom, okay, will be aware of the smoke alarm when it goes off. Because what if it's in that bedroom and the door's closed, so it'll be a little while before it gets to the hallway, right? Going under the door or through any cracks or whatever. Okay, number 13. Utility service to tenants is regulated by Property Code 92. One of these regulations is A, tenants are responsible for all utility charges if the apartment lease exceeds 1 year. B, tenants may not pay a landlord's utility bill to avoid any service interruption. C, the landlord may not cause utility service to be interrupted to the tenant as a means to collect unpaid rent. Or D, if a tenant is forced to pay a landlord's water bill for the apartment, the tenant nevertheless must continue to pay rent in full. So utility service to tenants is regulated by Property Code 92. One of these regulations is type your answer in the chat. Which one is true? Okay, so far I have C. Okay, I have C or D. The answer is C. The landlord may not cause utility service to be interrupted to the tenant as a means to collect unpaid rent. That's retaliation, not allowable. Landlord has to provide habitable unit, whether the tenant is paying or not. Now, it does happen. There are, like I said, slumlords or landlords that intimidate or don't follow the rules, okay? And they do that, take advantage of tenants. And then some tenants take advantage of landlords, all right, that follow the rules. So D says, if a tenant is forced to pay the landlord's water bill for the apartment, the tenant nevertheless must continue to pay rent in full. So utility service to tenants is regulated. Okay, one of these regulations is that the landlord cannot disrupt, interrupt, utilities for unpaid rent. So, they can't, tenants are not always responsible for all utility charges, right? That depends on the lease. Tenants may not pay a landlord's utility bill to avoid any service. Well, they could do that, okay, and then, get it back from the landlord. D, if a tenant is forced to pay a landlord's water bill for the apartment, the tenant nevertheless must continue to pay rent in full. Well, it just depends, right? They may end up leaving because it is the landlord's responsibility. So the answer was C. Gosh, I hate that little thing coming up. So one of the regulations is landlord cannot interrupt service. All right, number 14. So you got that, David? You answered D. If a tenant is forced to pay landlord's water bill for the apartment, the tenant nevertheless must continue to pay rent. I mean, yes. All right. Because landlord's right is to continue collecting. So number 14. Leases may be terminated in legitimate ways or by other means, which may be unlawful. Yeah. Which of the following is a perfectly legitimate cause for lease termination that does not carry a legal or financial liability? So leases may be terminated in legitimate ways. So which one does not carry a legal or financial liability? A, abandonment. B, conveyance of the property by landlord to another owner. C, death of the tenant. Or D, expiration of lease term. So which one of the following is perfectly legitimate cause for lease termination that does not carry a legal or financial liability? So in other words, landlord can't be taking somebody to court for one of the following. No, it is not C. So the answer is actually D. Expiration of the lease term does not carry a legal or financial liability. Okay, the lease expired, tenant can leave. If you answered C, C says death of the tenant. If the tenant dies and the property and everything is still in there, they can go after the family or a trust or whatever to collect whatever is owed, or for everything that is on there, any expenses. So the answer is D. Okay. Expiration of the lease term. So if somebody abandons the property, they can go after the tenant, right? If the landlord conveys the property by landlord to another owner, okay, that could carry a legal or financial liability if that landlord, didn't inform everybody or the new buyer, right, that there was a tenant there, because leases have to be warranted by the new owner. They don't just end when the property is sold. The lease goes through to the new owner. That's why investors buy rentals, right? And hopefully that it's occupied so that they're going to be getting income, as soon as they buy it. So when we're looking to sell an investment property, whether it be a residence or a multiplex, we want to make sure that they're occupied, because investors don't want to buy properties with a high vacancy rate. Like the one I bought, right? They were all occupied, right? By the wrong individuals that I had to slowly but surely get rid of. Learn the hard way. All right, number 15. When tenants default, the landlord may evict by following the correct procedures. Which of the following actions would be considered proper eviction procedure? Okay, by the landlord-tenant laws or tenant-landlord laws in the state. A, the landlord, with or without proper notice, can lock the tenant out of the premises. B, the tenant files a suit for possession. C, prior to filing a suit for possession, the landlord gives the tenant 14 days written notice following default where tenant does not vacate. Or D, armed with a writ of possession, the landlord gives notice of the demand to vacate, including removal of personal property. So which procedure is correct according to landlord-tenant laws? That a landlord may evict following correct procedures. No, it is not C. Take another attempt. D, 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 D. Yes, the answer is D. Okay. Armed with a writ of possession, okay, the landlord gives notice of the demand to vacate, including removal of personal property. So a landlord is going to go through a process of eviction by filing an eviction notice and at a local jurisdiction, just of the peace court. They're usually smaller courts, okay, that deal with a lot of this. And so when we go file that, there's different processes in the eviction, okay? And if the person doesn't leave after the notice, then there's a writ of possession where the policeman or somebody that's hired goes and lets them know, hey, you've got 2 hours to get out, or you have 24 hours to get out. And they're like, oh, but well, can I ask the landlord for more time? No, you already had all the time you wanted, because they already went to a hearing. They were told you've got to evict by this date. So that writ of possession, okay, a writ of execution means you've got to get out now, okay, including all your personal property. And sometimes the policemen don't give them enough time to move all their things. They're like, we'll be back at a certain time, as we told you. And if nothing is there, we're locking the door. So they'll change the locks, okay, and get the person out. So the answer is D. All right, so we're going to call it quits there, because remember, you have less questions for state than you do for national, and we started with 6, so we've done 10 questions. Normally I do 5. I went over, so lucky you. Okay, I used to do more, okay, but we run out of state questions, and there's only so many Texas state questions, so I have to repeat them. And what do I keep educating you with? I keep saying, repeat, 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 okay? Questions over and over and over until you recognize them, you see them, you notice the little keywords, you understand the answer. The more you do these questions, even the same question, take the test. You got an 80, take it again. You got a 90, take it again. You got 100, woohoo! Once you take all the quizzes, all the exams, take them again another day. Okay, you know, of course, including studying vocabulary. Okay, we haven't been doing vocabulary now because we're doing this book, all the national and the state questions. So there are vocabulary words. So in some of the questions we had today, the answers were incorrect because of vocabulary, right? The equity of, what was it? The equitable right of redemption. Go back and look that up or Google it. Googlealo. Okay. And understand them. You can memorize the vocabulary if you can memorize hundreds of them. Okay. Some people are great at memorizing. More than likely, you're not going to use most of them out in the real world. This is just to test your knowledge, okay, before you go into the real world and actually practice real estate activities. Lots different, okay? Here you're dealing with a book, an instructor, a tutor, you know, and quizzes. Once you're done, get your license, you're dealing with real people. Lots of different personalities. and realtors that can be easy to get along with, and others that can be terrible, rude, you know, not nice, but they're excellent realtors and they are successful. So, you know, what I always say, hey, respect everyone when you're out there in the industry, okay? Because everybody is doing the best that they can or that they know how, okay, to do the job of representing clients or dealing with title companies, lenders, inspectors, appraisers, you name it, everything, okay? So let's see what Cindy says. Says, yes, ma'am, thank you. Can you do another Texas exam like before? Yes, after we've got done with this one, then we will do just a Texas exam, okay? Or maybe a little bit of vocabulary. Yeah, so because of Cindy, I started doing Mondays. I was talking about Cindy this week, right? Because Cindy, you know, I say in here, you know, ask and you may receive. More than likely, you will receive, okay? And because I'm here to help you prepare to pass your exam. I want all of you to pass. I want you to be successful realtors. That's my goal. That's my passion, okay? And in the meantime, you know, who knows? Some of you may interview with the company that I'm with and join me, and the company will reward me for it, okay? So, but I've learned that I enjoy tutoring, teaching, which I didn't think I would. Once I got comfortable with being on screen. So I do happen to talk about Cindy, right? Because she participates a lot and she asks for things. So ask and you receive, okay? Close the loop and also give. So what I'm going to say is all of you that are watching on YouTube, and if you're not, please go to YouTube, okay? Click that thumbs up, send me some love. Send me some love, okay? And if it's the first time to my channel, or if it's a repeat time and you haven't hit that subscribe button, please tap the subscribe button, click that little bell so that you're the first to get notified every time I go live. And of course, click the thumbs up, okay? Thumbs up, right? Send some support, some love, write some comments, write a testimonial, anything like that will support my channel. And so now that I've reached 1,000 subscribers and more, I've started making a little bit of money from Amazon, from YouTube. So the more you watch my videos, encourage others to come to my videos, it supports my channel and I start making a little bit of money, which I never thought about it when I started YouTube. Okay. I just started it because it was another way and I learned. So let's see here. Yes, either I'm so good with. All right, good. All right. So if no further questions, I am a live acting realtor. I met with some other realtors this week and we're strategizing to do some new things, maybe some events, some training classes and such. And I am working with clients right now, buyers, but I am now sending out direct mail. I'm sending out letters to expireds, right? Because that's a way to get a lot of listings. And so let me show you. Last night I stayed up till like 11 or midnight and typed my expired letter, right? So that I can send this out to properties that are on the MLS that expire. So now that we're in a more of a buyer's market, its market has been shifting from a seller's market to a buyer's market. Not on all areas or all properties. And so now is a good time to start sending out expired letters and to also for sale by owners and unoccupied properties or properties that are owned by out of the area owners, because now we're going to be working a little bit more to get listings, okay? The interest rates have gone up to over 7%. Therefore, right now, sellers may be asked by buyers, okay, and the lenders recommending to buyers and the realtors to request buyer closing costs or request interest rate buy downs, okay? And so those buy downs can cost several $1,000s to bring the interest rate from 7% to 6% or lower. And wow, the last time I saw 7% was years and years and years ago. Back in with that commercial property that I mentioned that I bought, the 8-plex, my interest rate was 9%. And it was an ARM. What is an ARM? Adjustable rate mortgage, right? Not this kind of an ARM, but an adjustable rate mortgage. And so luckily, the market started crashing. My interest rate went down to 5.5%. Typically, it may go up, but the interest rate went down. So my payments really reduced, which was great because I was getting the same income of rentals and less principal, less interest on my loan. Okay. So interest rates have gone up. So market is changing. So anyway, I'm now sending out expired letters, to attract sellers that their property hasn't sold in the market. That's how I used to get a lot of my listings, okay, to represent sellers. And they still want to sell, right? The majority of them. It just didn't sell while they were with another realtor. And it's not always the realtor's fault. It could be that it was overpriced or it hadn't been maintained or it wasn't very, didn't have a good curb appeal and such. All right, y'all. So any other comments? Anything else? If not, until next time, catch you later. That'll be Monday. Have an awesome weekend. First day of October.